Welcome to Energy Bites with ELS. Today we're looking at the investment climate in Europe, inspired by this week's episode of Energisnack with Elin and Lina, where our CEO Elena Kinsey joins the discussion. I'm your host, Carl Rosenberg. Okay, welcome to Energy Bites with ELS. Conversations on Europe's energy markets, policy, and investment risks. I'm here with Mari, Shana, and Samuel today. Welcome to all of you.
Thank you.
Thank you.
If you look at energy investments today and you feel like the story is a bit confused, I would say that that's because it is. The last 5 or so years has completely rewired how energy investment works. COVID sort of broke the taboo, so to speak, especially on EU and state intervention. The war in Ukraine turned energy into a security issue overnight, and the US's Inflation Reduction Act sort of kicked off a global subsidy race, and together these shocks has sort of pulled energy out of the market economy and straight into geopolitics. And in my opinion, that's where you sort of have to start. And at a global level, the energy transition hasn't stopped, of course, but it has stopped being a single shared project. Capital is no longer flowing in one direction. It's being pulled apart by national interests, by political risks, and very different ideas about who should carry the cost. And Elin and Lina yesterday touched upon China, and I think that is a very good place to start because it hasn't really changed course at all. Investment there keeps going, solar, wind, batteries, grids, all of it keeps expanding, not because every project makes money, but because it serves a shared industrial policy. And the result is that China keeps setting global price floors and to some extent ceilings. And as Elin and Linda also mentioned in that podcast, the US has gone in an opposite direction. There hasn't been a real pivot, especially with regards to political signaling. The infamous Inflation Reduction Act has disappeared. And it doesn't really drive decisions the way it did in 2022 or in 2023. And here Europe sort of sits in the middle. Policy is still supportive, and the state aid rules are more flexible than they were. Europe has hit some sort of barriers, it seems. And as Elin and Mincha also talked about in the podcast earlier this week, companies like BP and Shell have clearly stepped back on the market front. They may talk about the transition, but capital has shifted. Offshore wind and hydrogen have been cut back. The focus is now back on oil and gas, maybe biofuels to some extent, things that generate cash and don't blow up the balance sheet. And that leaves a gap. In Europe, utilities like EDF, Iberdrola, and Engie may be able to step in to some extent, infrastructure funds too, but they come with limits. Political risk here matters. So things are slowing down. It is becoming more selective. So to sort of wrap this up, the big picture sort of looks like this. If one sort of buys into this narrative, China keeps building, regardless, of course, of returns. The US invests, but more cautiously. Europe stays supportive, but is constrained. Oil majors are pulling back, and utilities and infrastructure investors are stepping in, but slowly and selectively. So based on this narrative, to sort of throw it back to the group here, what choices does the EU actually face now on climate and energy? Sam, why don't you start?
Thank you, Carl. I think that was actually a really good summary of kind of the last 5 years or so, as you started off saying. It's Europe is obviously. I mean, everybody knows Europe is in a pickle, but I think that the thing here, which we kind of have to pin our hopes on, is being able to set creativity free. And I think this is a bit of a in a way, this is what we talk about when we talk about the competitiveness of Europe. But I think quite often, the focus tends to then be on regulations and kind of all the sort of red tape, which has to do with creativity at the core of it. But quite often, we think of it as more the superficial sort of running of things and how easy it is to do business in a wider sense. But China has stolen a march. Europe is sort of right now stuck with its import dependency for its energy needs. We have shifted it away from Russia for now, quite successfully. But we look set to continue it unless we actually manage to keep up the flow of investment and building out of renewables mainly, because obviously we don't have any fossil, and we don't want more fossil production. But even if we wanted that, there isn't any to develop really. So that is really our option, sort of, if we want to break free of import dependence, that and nuclear. So then obviously China has stolen a march here because they are now dominant in all these technologies, frankly. Even though we do have nuclear technologies in Europe, we still sort of we need to prove that we can actually do it at such a commercial basis that China, but also Korea and are doing. So this is, we really need to set our creativity free, and I think there is a. I mean, we actually do have a strength. We actually do have, I think, a leg up. Could have, if we manage to set that free properly, because this is actually the weakness of all kind of authoritarian systems, right? They can't really cope with creativity, not as well as free democracies. So that is actually what I to try to sound on a positive note, actually, because it's so easy to stare sort of on how all the troubles that our manufacturing industry is suffering in Europe, etc., 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 and how we sort of lost the technology march sort of in solar and in wind and on batteries, etc., to China. But we once sort of led this, and we could probably do it again. Uh, it is just I think we need to talk maybe more about what can we do to set creativity free as a sort of starting point, and then making sure that that can translate into viable businesses, etc., etc. Maybe that's the way to do it. I think we actually we do have a good core advantage to build on here.
Jonna, what is your, why don't you weigh in here? What is your opinion on where the EU is from a regulatory perspective, given the latest revisions of ETS2 and now earlier this week, the 2035 combustion ban? Are we sort of heading in the right direction, or what does this pivot mean?
Yeah, well, I'm usually the person in the room defending the EU, but right now the EU choices seem to be quite constrained. We've had a year that has been all about framing policy around affordability and industrial competitiveness, which we need, given what's happening outside of the EU. But actually, the thing is that Brussels can set all the rules they want, but then the real money and the implementation is sitting in the national governments, and that's what shapes the outcome, really. We've had a very heavy year, regulatory speaking, and the EU has made its choices, its revisions, it has implemented new regulations, but now it's all about implementation, and I really think this should be about flexibility. So flexibility for countries to choose which paths they want to follow regarding climate and energy, but all of us with one common goal and the same objective, really.
Mari?
Yeah, no, I think it's super interesting how you spoke about creativity, Samuel, and how you speak about regulation, Shana, because I think even if we do have that sort of benefit of being able to be creative in this, I think the sort of policy discussion we're hearing is a lot that we have very ambitious targets, which are setting sort of the stage of where to go, but then also quite stringent criteria as to how to meet those targets. And I think that has, together obviously with the competitiveness and the focus on defense after the Ukraine war, sort of really limited the feeling of creativity within these markets. And whether it's an actual limit or not, I think one can discuss for a long time, but I very much agree that it's this sort of choice in the EU now where they're looking at simplification and flexibilities, but on the other hand, trying to stay ambitious and create a predictable investment environment for industries, which is not really happening because there's these revisions now coming up, and with a new shift towards simplification, it's also the question of whether the set demand and ambitious targets will actually be met. Will it create a sort of market, especially in these nascent markets, which is creating more unpredictability, I think, than actual stable investments. But on the other hand, I think you can also say that it does, setting a goal by itself does sort of see where we want to go. And if we do increase more flexibility on the EU side, I think that could spark that creativity once more, where the EU can prioritize being good at what they can be good at.
I completely agree, Maria. I think you're making a couple of great points here. The EU needs to come to terms with that none of the paths it has in front of itself is cost-free. But I think the key trade-off, at least in my opinion, now isn't just about speed versus ambition. It's about credibility, right? The EU is currently signaling will adjust X later. But as the more the EU does these things or signals this sort of hesitancy, the more investors start pricing in policy risk. And you see it very clearly in the behavior. The time horizons shorten, the required return rate goes up, and the capital concentrates in fewer and fewer markets. And it's those markets that still feel underwritable. So there's a bit of a paradox here, trying to buy flexibility by delaying, by softening or resequencing parts of the transition can actually make the transition more expensive, not cheaper, if it undermines the confidence in the sort of long-term direction. And I think that's the tension Europe is currently navigating right now. And in that sense, 2025 hasn't really been about a large pivot in sort of choosing a new target. It's about revealing sort of which policy path the system is actually on. So Shauna, sort of going back to sort of where we are today and my initial question about COVID and state aid, where do you see today's European renewable investment going? And with from the state aid perspective, is there sort of a growing concentration risk of where capital flows to a smaller number of very mature markets because, support schemes and permitting frameworks are easier to sort of navigate in these certain markets?
Yeah, for sure. I mean, it's true that there is a real concentration issue here. And I don't think it's solely based on how sunny Spain is or how the wind is blowing in Germany. At the end of the day, the capital is going to flow to where you get faster permitting, more clear grid connections, better conditions, and of course, where you have a mature market and less risk. But again, and I feel like I'm always repeating myself, but the EU gives the member states a ton of tools that they can use to boost renewables, to the risk projects, to invest in infrastructure. And of course, the larger countries will have more funds to use. That's completely true. But there is also a specific fund in Europe called the Modernization Fund, which is exclusively for the less developed countries within the EU. And honestly, this issue that you're raising here is something that's very visible in the EU Hydrogen Bank auction. Germany and Spain have been countries signing up for the auction as a service mechanisms now in this third auction, but they have been doing so in the other ones. We also saw Lithuania doing that one time too. And again, there are differences in the economic capabilities of the member states. That's true. But I really think that it is a matter of the member states to make an efficient and an intelligent use of the tools that the EU has at their disposal, really. We're seeing capital flow into Germany and Spain. Well, perhaps we could ask ourselves, or the other governments should ask themselves, why is this happening, right? What are the investors seeing in Germany and Spain that they don't see here? And what can we do so that the same happens to us, right?
Absolutely. Sam, Mari, what market developments have you sort of have caught your eye, so to speak?
No, but I agree with Shana. I think we sometimes underestimate how much infrastructure impacts investments, and where, not only from like a perspective of where investments go, but also where they should go, right? I mean, we had a very recent discussion in Norway about hydrogen infrastructure. It's a lot of these sort of outskirts countries, obviously Norway is not part of the EU, but still in Europe, have much more difficulty creating the infrastructure for a sort of market compared to what we can see more in Central Europe, where, I mean, obviously, in regards to hydrogen, Germany also has made a lot of investments into infrastructure and pipelines, trying to create a market for it. But it's also in a location where it sort of can make a market for it, right? Because it is close to a lot of these different points of, I mean, say, both for e-fuel, for where you have the ability to source carbon, where you have ability to transport it, right? So I think the sort of lagged investments in infrastructure, both on the power side, I know that the expansion of grids is going slower than anticipated, even if there are being made investments here. But I think that is sort of maybe not communicated, but like an issue that really also pushes investments into certain regions. What do you think, Sam?
Super points, actually, Mari. And I was just starting to think alongside some similar lines. And also, thinking about how Carl even opened this podcast. I mean, I actually think, you said Norway, and I think you almost use a kind of word of a high threshold country or something like that. Norway and Sweden, similar in a sense. Obviously we shouldn't call Norway not a gas country, because it definitely is a gas country, but it's a producer with an export links down to Europe, right? But Sweden and Norway share the fact that we don't really have big national infrastructure for natural gas in our countries to distribute it across the country to our citizens and our businesses. So that has made us a bit of a high threshold country in Europe when it comes to just kind of building out the hydrogen economy as it has been envisioned. And I think, there was nothing really wrong with those visions. They were very, we needed something to do with a completely electrified and very high renewable economy. And as people were looking at these issues in 2019, 2020, 2021, there was actually a window, even for those high threshold when it comes to infrastructure countries, hydrogen countries, like Sweden and Norway. But at the same time, we should remember low production cost, so not high threshold in that sense. There was a window of opportunity to actually get proper big scale financing in order to do this, to kind of build out the same vision of widely used hydrogen in order to decarbonize all sort of hard to abate industries, maybe even make some hydrogen out of some other more or less esoteric, depending on where you stand, sort of uses for commercial users and private users, and all that kind of stuff, which were in the overall EU vision for hydrogen. We had that window of opportunity. It would have taken a lot of funds, but there seemed to be a willingness, market willingness, there seemed to be a political willingness to back up the vision, at least on a European level, etc. But after the war in 2022 broke out, Russia's attack on Ukraine, renewed attack on Ukraine, we're just not really there yet, anymore. And I think this sort of, there has to be a frank acknowledgement of that on the EU level, because right now we're still sort of talking, and especially on a political level, there's still talk like if we could sort of square all these different circles, but we won't be able to. We've spent, and we will spend, and we will have to spend so much on security that we will not be able to spend all that much on other parts of the energy sector and energy spectrum and the transition, and not on the hydrogen economy. And I don't want to, I'm not saying, the plug has been pulled from the hydrogen economy, because I still think, hard to abate sectors, and there are several of them, will need some form of hydrogen related answer. But this kind of, particularly in a country which is, or in countries that are very kind of geographically dispersed industries and future demand centers, this will be a bit too tough. That, of course, opens some other, interesting and not necessarily politically desired investment schemes, because we do, after all, still have very low production costs up here. And we might well attract investment into projects which are looking at exporting their offtake, and that offtake not being an industrial product, but maybe a sort of either a hydrogen or a kind of e-fuel or something like that, which right now is not politically desirable, at least not in Sweden. And you can argue whether it should be or not be, but that's not sort of where politics want to go. But there is some business interest for it, and you can't sort of fault it entirely, sort of, at least not on pure economics sometimes. So this is going to be very interesting, and I think this just shows again, how things have changed in those years, and also how scattered, indeed confused, as you started off saying, Carl, the situation is.
I think you're making a couple of very good points there, Sam. Unfortunately, we are sort of heading over the 20-minute mark, so I thought we would finish off this podcast with the last question. With 2025 coming to a close, what are we keeping an eye on in 2026? Shana, why don't you start on the EU regulatory side?
Yeah, of course, we have a very busy regulatory agenda for 2026 too. Actually, we follow this agenda on our monthly product called Vista. And in Q1, we have some interesting files being unveiled. We will have the Electrification Action Plan, also the Industrial Accelerator Act, some rules on electricity market integration, and the Early Movers Alliance to take some shape ahead of funding sustainable aviation and maritime fuels. But generally speaking, I think I will keep an eye on what happens with the 2040 climate targets. And once there is an agreement on that, how the post-2030 architecture is going to be built. Of course, this is not going to happen in 1 year, but I think we will be able to get some signals of the direction that this will take. And especially with the strengthening energy security package that will be released also in Q1. So how we are building the post-2030 energy and climate system, I think it's going to be key this year.
Mari?
Yeah, no, I agree, Shana. It's also the EU ETS review coming up next year. It's also the first reporting year for the SAF and greenhouse gas reduction targets in maritime. And I'm very interested to see how the EU sort of complies with that, or how they will implement compliance. Because I think that could be, speaking of investments in nascent markets, I think that could be a very strong policy signal either way. Either compliance is maybe not as strictly enforced, or maybe it will be and sort of lift new investments, so that there actually creates a sort of more stable demand market where policy is kept. So I'm very interested to follow that next year.
Sam?
Well, two things. I think one on the power side. I mean, we're starting to have a public debate and political debate rather ahead of elections, where people are moving towards sort of trying to push for putting together or merging Sweden's bidding zones. And also a rather sort of anti-export, anti-power export narrative forming. Where will this go? It's very much a striking clash with EU intentions on both those issues. So I think that would be very interesting to watch. The other issue is gas, I think, and this time natural gas. I mean, since we have so little political support now for hydrogen projects, even in the hard to abate sectors. I mean, look at the debate in Sweden about Stegra recently, and writings in media and so on. Then companies are clearly looking, okay, what can they do? What's the mid-term solutions? And here, natural gas (LNG) is coming up as a solution to look at. And at the same time, we're also during this year seen natural gas starting to play a role in power production, power generation, power cost on the power markets in a way which it hasn't really traditionally done in Sweden for a very long time, if at all. So those are very interesting issues where Sweden is really moving sort of counter to the rest of Europe, where gas, obviously being extremely important, is something you're trying to sort of minimize and manage. We are moving into more of an export dependency in both our industrial production potentially and in our power markets. Could be called tone deaf from a geopolitical sense, perhaps, but let's see where this develops. At the same time, commercially, it's not necessarily a bad solution at all. If you can't sort of take the whole step, then at least take a half one.
Okay. I have a couple of interesting topics that I will be following. First, real demand numbers, not announcements, but actual load growth. So that's industrial power demand, data centers, electrification in heating and transport. If demand doesn't materialize, investment economics may need to change and change quickly. Second, grid delivery. EU launched a grid policy package recently. And third, hydrogen. Do we see a first wave of sort of genuinely bankable FIDs, or do projects sort of remain stuck in this sort of conditional support? And then policy discipline does... whether the EU can sort of hold a coherent line on renewables, but also policy discipline with regards to the sanctioned Russian gas. Following that story, I think, will be critical. But I think that was all from us at ELS. Wishing you all a Merry Christmas and a Happy New Year.
Merry Christmas and Happy New Year.
Happy holidays.
Goodbye.